Damn! 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 Damn!
Target stock ticker symbol TGT reported earnings today, and the stock was down 6.33%, at one point being down about 10%. Pairing some of those losses, however, still negative on the day, and we're going to talk about Target, why it's falling, and what does it say about the consumer, and also if Target is a buy. But before we dive in, if you guys could please go ahead, like and subscribe, it really helps me out. Let's dive in. Now, you guys all know what Target is, a massive, large general merchandising retailer. It operates physical stores, online stores, and offers a wide variety of products, including apparel, beauty products, household essentials, food, beverages, home furnishings, everything in between. They sell pretty much everything. Now, the quarter was okay, I guess. Revenue and EPS fell, especially EPS fell 20%. However, the market knew this was coming. EPS estimates came roughly in line at $2.05 a share. The analyst revenue expectations did beat, however, ever so slightly, however, still falling in revenue on a year-over-year basis. And the quarter, actually, when you dive into the details, wasn't that great. Gross margins slipped, net income margins slipped, net income fell on a year-over-year basis. Free cash flow also fell on a year-over-year basis. And that's because comp sales actually declined 1.9%, very ugly compared to 2% in the quarter last year. And the balance sheet is all right. A lot of these general merchandisers have quite a lot of debt because of the real estate they own, but they have $19.9 billion in debt, $4.3 billion in cash. And this is really just a margin story here for this business. You know, a lot of external and organic factors are impacting their margins, from the gross margin to the net income margin to the free cash flow margin. And that is all due to just comp sales declining, a higher cost of doing business. And this is through and through. Look, net sales fell, comparable sales fell, store comparable sales fell. Digital comp sales actually grew 4.3%. That was probably the highlight of the quarter, along with the fact that management did say they saw improvement across their 6 major categories from Q1 to Q2. So they saw a change sequentially, but still negative, right? So I think last quarter it was negative 2.9% or negative 3.9%. It's now at negative 1.9%. And you can see this has sort of been the trend for a while. We have seen periods where comp sales do increase on a sequential basis, but from the peak in 2022, revenue per store has declined as a result, and that's just because comp sales and the higher cost of doing business. And let me show you what I mean. You can see net sales fell 0.09%, so pretty much flat on the year, right? The cost of sales increased ever so slightly. So that's already a red flag right there. You always want your revenue to increase faster than your cost of sales. And at the same time, right, operating expenses was just flat, literally flat. There was no change on a year-over-year basis. But compared to revenue falling, that is actually a bit of a miss. And that is why we actually saw net earnings fall 21.5%, coupled with the fact that they have, a lot of interest on their debt. And this is a profitable enterprise, so they do have to provision for taxes. At the same time, I think the market just wanted a little bit more out of their guidance. They went ahead and reaffirmed their guidance, which, wasn't really great to begin with. They maintained its expectations for the full year, which is GAAP EPS of $8 to $10 per share. Now, that's a really wide range. At the midpoint is $9. The stock trades at about $99 per share. So, on full year 25 GAAP EPS estimates, you're looking at about a 9 to 10 times forward earnings is what the stock is trading at. But when you look at it on an adjusted basis, which excludes gains or losses from litigation settlements, you're looking at about $7 to $9. So still, the stock, at $99 a share, trading at 11 or 12 times, potentially 13 times, not expensive in the grand scheme of things. Now, Target is going through a lot of issues, especially when you look at their financials. Net sales not growing, operating expenses increasing ever so slightly, net earnings falling significantly. And as a result, they replaced their CEO. The new CEO will be Michael Fidelki. Now, this guy has had a long and rich history with Target. It was a unanimous decision by the board to elect him as incoming CEO. He is currently the COO. He started as a finance intern in 2003 at Target. Apparently, he just loved working for Target and has worked his way up to become the head honcho, the COO. And it's his job to navigate these external factors that I managed to find on the earnings call. Now, The big thing here I think he needs to tackle is the same store sales decline. This has been declining since 2022. I think in large part it has to do with competition from Walmart, Amazon, Costco, etc. Something else the company's trying to do is maintain their pricing based on sourcing. Rising sourcing costs and has challenged pricing and margins as well as tariffs. So they're going to have to navigate that. And this is all a part of their organic problems that are specific to Target. And then they also have these traffic problems. Fewer stores and fewer online visitors are hurting sales, again, in large part due to stuff like Amazon, but also due to stuff like DEI issues, protests, thefts, right? I mean, Target now has like massive glass doors where you have to like call a store patron to get them opened. That is really, people don't want to go do that. People are not going to go into your store if that is the case. Coupled with, again, like I said, activist protests which disrupt operations. A ton of theft is happening at Target, as well as labor strikes of wage disputes and operations. So if he can manage the external problems, it should partially offset the organic problems, but then there's also this competition and same source sales problem that the CEO has a lot of his work cut out for him. That being said, even though Target has a massive amount of issues, is the stock a buy right now? Because, technically speaking, it is cheap, trading at a 7.4 times EV to EBITDA, 12.9 times PE. The median over the last 10 years or 5 years is 17 times. And so essentially the price, the stock, the stock is priced for continued sales decline. If the new CEO can reverse that, there definitely can be multiple expansion. So that is something you're looking for in the stock, but there is currently a shareholder yield of 9.5%. The company pays a great dividend. They buy back shares. In fact, they buy back about 1% of the shares outstanding. They actually pay a 4.56% dividend as it is right now. So you are getting value as a shareholder. So when I'm valuing the company, this is what I'm going to look to do. So I'm looking at $105 billion in revenue. That's growing to $116 billion by 2029. So you're looking at about a 2% revenue growth compounded over the next 5 years. Net margins going from about 3.7% to 4.5%. And you're looking at net income of about $5.2 billion. So using a PE of 15, which is below the historical average, the current PE is 11. We then get the enterprise value, subtract the net debt, then you get the equity value and divide by shares outstanding, which decline again 1% every single year. You get a stock price in 2029 of $146 per share. Current stock price is 98. With a 4.5% dividend yield, you're looking at about a 12% compounded annual return right here. Now, if the company can get back to, let's say, 6% peak margins like they did have in 2022, right? You're then looking at some substantial upside of about a compounded annual growth of about 20% on a 15% PE multiple. But because of what the company is going through right now, I think you should probably expect a multiple closer to 12, maybe even 13 times versus where it is right now at 11. But you're still looking at about a 16% compounded annual growth. But I think these margin levels are a bit frothy. I think 4.5 is probably what you're going to look at right now for margin. You can use a 13 PE, again, sort of in the middle of between 11 and 15. And then you're looking at, a possible return there of about 8%. And that's assuming revenue stays as is. These are consensus estimates. If there's upside to revenue, there's obviously upside to these figures. But is Target a buy right now? I would say no. The reason why the stock trades at such a dirt cheap multiple is because the street is saying, hey, the fundamentals are deteriorating in a very, very big way. Competition is encroaching. The company has a lot of organic issues, hence the lower multiple. However, from a technical standpoint, the stock does, I guess you could say it is a buy right now at this $100 mark. You could see that this was a key level of support right here. And ultimately, we are seeing a little bit of consolidation here at the $100 level. And you would say then, hey, we probably should go up from here. However, you do have to look at it, right? We put an all-time high right here. Then we put in a low, a high, a lower low, an equal high, and now another lower low relative to this low, which means we are literally in a downtrend, as you can see right there. And unless we actually go ahead and retake some of the highs we found right here at the $120, $130 mark, right? If we don't go ahead and take those, it does look like we can actually continue this downtrend right here. So for a short-term trade, I mean, if Target can reverse some of the issues that they're having, we could see the stock bounce. But what I would really do is wait for strength, wait for the fundamentals to turn before buying it. Target to me is not a buy right now. I prefer companies with significantly better fundamentals. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.